A recent report by Financial Educators Council found an average person loses $2,000 every single year because of a lack of financial literacy. If you look at investors, a 2018 Journal of Finance study found that investors can lose an average of 4% per year because of not understanding their own biases and how it affects them. This got me thinking, what are these biases everybody's talking about? And I went into this rabbit hole of financial research. To save you time, I've summarized the 3 main categories that affect your investment and why you should be aware of them. Because it could mean you're losing an average of 4% every single year. Compounded, I don't even want to know how much that is. Most of my findings were from this research, Determinants of Investors' Behavior, an analytical review by S.S. Selfie and Faisal Al-Qahtani. Feel free to look this up. I'll leave a link down in the description. Yours truly has summarized everything after hours of reading. The first type of bias is psychological bias, also called emotional bias. These often lead to irrational decision making since we don't want to spend time analyzing our own emotions. The number one psychological or emotional bias is overconfidence bias. Basically, people overestimate their abilities to make good investments. I probably have been guilty of this, and maybe you as well, but a lot of people believe they have superior knowledge over other people when it comes to stock picking or choosing investments. This primarily, according to research, leads to overtrading, which is always a negative for the investor. A study found out that overconfident traders trade 45% more than the average trader, but their returns are 2.65% lower. This also is somewhat tied to the second psychological bias, which is herding behavior. We often want to mimic the actions of others, and if we see a lot of people doing the same things in our vicinity, we most times want to follow them. And the algorithm on YouTube and social media has exacerbated this issue. We're only shown concepts and ideas that we already agree with pretty much. If you are a growth investor, you're going to be shown equities and high growth stocks. If you are a dividend investor, you're going to be shown covered call creators or people living and dying by investing everything in covered call ETFs. The point is to recognize this herding behavior, which is more pronounced in down markets according to research, and even in uptrending markets. For example, right before the 2008 financial crash, everybody was investing in mortgage-backed securities because they saw everybody else doing it. So the first 2 psychological biases are relatively linked. The third one is more to do with cutting losses or loss aversion. Studies have shown that for some people, the pain of losing is way more than the joy of an equivalent gain. This basically means that investors hold on to their losing investments for a longer period of time than they actually should. A 2022 study found that 71% of investors exhibit this loss aversive behavior, holding on to their losing investments for way longer than they actually should, even with other investments out there that better align with their financial goals. I've been guilty of this as well when I should have sold stocks way before than I actually did because the pain of that loss, the red, seem too great. Psychological bias is one thing, and we've understood that now. The second big category is demographic variables. The number one factor in this is the age of the investor itself. Studies have found that younger investors below 30 attribute 90% of their entire portfolio on average to stocks and equities. Since they have a long-term time horizon, individuals over 50 switch these equities to more fixed income securities. The problem is that 50 is not that old when you think about it. The average age in America is nearly 78 years old. If you're 50, you have around 30 more years to live. Understanding that you have this bias of getting fixed income now might not lead to the most optimal retirement is something that we should all consider. Another big factor in this is the gender of the investor. Studies have found that female investors are generally more risk averse, but that also means that they, on average, outperform male investors. In 2018, the Warwick Business School found that female investors outperform male investors by 1.8%, all things equal. This is primarily because they're risk averse and avoid excessive trading. Men, including myself, are more guilty of overconfidence, leading to riskier investments. If I take myself as an example, I do individual pick companies and would probably be better off if I just bought ETFs. So whether you're a man or a woman, knowing that you have these tendencies is very important when it comes to building a long-term portfolio. No woman really watches my videos according to my analytics, so guys, know that you have biases. Even if you recognize age and gender biases, you cannot ignore education biases. Studies have found that individuals with a college degree are 25% more likely to invest in equities. People with a high school diploma are more likely to choose safer investments, like savings accounts. This can greatly diminish their returns and also highlights a need for financial literacy in high schools, not just college campuses. And the last factor that is primarily important is the income level of the individual. Of course, it makes sense. People people with a higher income are able to invest in equities and take on more risk since they have an emergency fund or some sort of finances to fall back on. People with an income more than $100,000, according to research, are 60% more likely to invest in the stock market than people with an income less than $50,000. Now, the point isn't that people with a lower income should YOLO all of their money into the stock market. It is to make them aware of the fact that the stock market does exist as a vehicle for investment. The last bucket that we have to understand is socio-economic factors. This includes factors like socio-economic policy, cultural influences, and the availability itself of financial information. Economic stability is the biggest factor that plays into this. Because of economic stability, investors can greatly, to a large degree, structure what they want from their portfolio. Their financial strategies and risk tolerance is way different than someone that doesn't have that economic stability. This is also because they have access to a bunch of strategies. If you're in the US or Canada, you have access to hundreds, even thousands of investment instruments. Equities, bonds, treasury bills, ETFs tracking literally everything that you can imagine, all different sectors. And this access leads to high participation in the economic system. Studies have found that 80% of people in developed economies have direct access to a financial resource or have claimed to use one, compared to only 37% in developing economies. That basically means even though the stock market returns for developing economies might be much higher than other assets, people just don't choose to invest. They opt for other safer investments like gold, savings accounts, or even real estate. Investments that return less but are just better off in a less stable system. The IMF found that only 10% of households in developing economies actually participate in the stock market, even though the returns of the stock market might be exceptional. That's 1 in 10 people taking advantage of the stock market, even though the returns are good, just because of a lack of stability. The second factor that plays into this is cultural norms and traditions. What family and what culture you grow in can shape your attitude towards saving, investment, and just risk tolerance. Some cultures really hone down on financial security and protecting your money, leading to low-risk investments like bonds or savings accounts. Sometimes not even touching your money at all and keeping it in a checkings account, because that for them is saving. I'm actually brown, as you can see. I'm not white or any other ethnicity. When I was growing up, my parents and those around me didn't really know about the stock market or other investment vehicles. All they knew is savings accounts and real estate. Even though the savings rates for these countries, particularly Japan, is really high, the stock market participation is low. Going to myself as an example again, when I saw that people like real estate over the stock market and I looked at the returns, I always saw the stock market beating the real estate market, and I wondered why. On the contrary, societies that take on more risk have more stock market participants. A recent study found that 56% of Americans have participated in the stock market at least once in their lifetime. And perhaps tying all three of these buckets is the access to financial information. If you have access to information, you're way more likely to start investing. Information can simply even mean participating in a financial literacy workshop. Studies have found that participants of financial literacy workshops are 70% more likely to start investing within a year. Just one workshop can completely change your future. And why financial workshops are extremely important is because we usually get information and advice from our friends and family. According to Standard Chartered Bank, 64% of people that they surveyed said that the friends and family they had were their primary source of financial information. This needs to change because that leads to suboptimal outcomes and the reiteration of perhaps outdated financial beliefs. So always look to acquire more information, even if it negates what you believe in, because that is where the actual learning is. I hope this video helped you understand some of your biases and how you can work towards making sure they don't affect your investment journey. As always, smash the like button and the subscribe button if you enjoyed this video. Every subscriber helps get this video to the right people also interested in learning how to save more, invest more, or just simply understand how money works. I'll see you in the next one.